In a world where financial security is a priority for many, building wealth can feel like navigating a vast, ever-changing ocean. Whether you're looking to secure your retirement, fund a major life goal, or simply grow your financial assets, crafting a strong investment portfolio is one of the most powerful steps you can take. But with an overwhelming array of strategies, it's easy to feel lost in a sea of options. What if there was a roadmap to guide you through the noise? What if there were 9 time-tested strategies that could steer your financial future toward long-term prosperity? This is exactly what we're diving into today. Did you know that something as simple as tweaking your investment approach could yield massive returns, or that you could be missing out on one of the most powerful wealth-building tools in existence? By the end of this guide, you'll not only understand how to grow your portfolio, you'll be equipped with actionable strategies that have the potential to change your financial future forever. So let's get started. The foundation of any successful investment journey is choosing a strategy that aligns with your financial goals and personal preferences. Are you someone who enjoys analyzing charts and making quick decisions? If so, trading in the foreign exchange market might be your calling. However, if you're not comfortable with the technical analysis required for such trades, you might find more success in traditional stocks or mutual funds. It's crucial to consider your expertise in specific investment vehicles. Some strategies demand a deep understanding of particular markets or asset classes. For example, if you're well-versed in real estate, it makes sense to focus your portfolio on property investments. By tailoring your strategy to your strengths and goals, you can maximize your potential returns while minimizing unnecessary risks. Specific goals are the cornerstone of a successful investment strategy. Without well-defined objectives, it's easy to lose direction and make impulsive decisions that can harm your portfolio. Your goals should be both specific and realistic. Instead of vague aspirations like "I want to get rich," aim for measurable targets, such as "I want to achieve a 10% annual return on my portfolio over the next 5 years." Individual goals vary based on financial circumstances and aspirations. Some investors prioritize long-term growth, while others focus on generating short-term income. When setting your goals, consider factors such as your risk tolerance, time horizon, and financial obligations. These elements will help you create a roadmap that guides your investment decisions and keeps you on track. One of the most valuable pieces of advice from successful investors is to adopt a long-term perspective. Legendary investor Warren Buffett, for example, has held onto many of his investments for decades, reaping the rewards of patience and compound growth. Long-term investing offers several advantages. It reduces the need for constant monitoring of your portfolio, freeing up time for other pursuits. Additionally, it allows your investments to grow steadily, benefiting from the power of compounding. Unlike short-term trading, which requires frequent adjustments and can be time-consuming, long-term investing lets you set it and forget it, giving your portfolio the time it needs to mature and flourish. The strategy of buying low and selling high can be tempting, but it's fraught with challenges. While some investors believe they can outperform the market by carefully timing their trades, the reality is far more complex. Studies such as those conducted by Spiva show that over 80% of asset managers fail to outperform the market, demonstrating the difficulty of consistently predicting market movements. For the average investor, trying to time the market can lead to costly mistakes. It requires constant vigilance and a deep understanding of market trends, which many simply don't have the time or expertise to develop. Instead, a focus on long-term strategy and consistent investment can yield more reliable results. Diversification is a powerful strategy for managing risk and enhancing your portfolio's stability. By spreading your investments across various asset classes, such as stocks, bonds, real estate, and commodities, you reduce the impact of any single investment's poor performance on your overall portfolio. The key to successful diversification is asset allocation. By carefully balancing your investments, you can achieve growth with less risk and volatility. For example, while one asset class may be underperforming, another might be thriving, helping to offset potential losses. Investors seeking above-average returns might consider focusing on high-growth sectors like technology or emerging markets. These sectors often offer greater potential for profit but come with increased volatility. The key is to identify industries or assets with consistent growth potential and to be prepared for the ups and downs that come with them. Longer holding periods and selective investing can help mitigate some of the risks associated with growth sectors. Compound interest is often described as the eighth wonder of the world because of its powerful effect on wealth accumulation. The concept is simple. By reinvesting the interest earned on your investments, you allow your money to grow exponentially over time. The earlier you start investing, the more time your investments have to compound. Even small, regular contributions can lead to significant wealth over the long term, thanks to the compounding effect. This makes it essential to prioritize investing as soon as possible, ensuring that your money works for you and continues to grow. As your investments perform differently over time, your portfolio's asset allocation may drift from its original target. Rebalancing is the process of adjusting your portfolio to maintain your desired allocation and risk level. Regular rebalancing ensures that you don't become overly exposed to a particular asset class, which might have performed well in the short term but carries higher long-term risks. By periodically reviewing and adjusting your portfolio, you can manage risk more effectively and stay aligned with your investment goals. Rebalancing should be done thoughtfully, not as a reaction to short-term market fluctuations. A long-term perspective and thorough analysis are essential to ensure that your adjustments are in line with your overall strategy. Dollar cost averaging is a straightforward yet effective investment strategy. By investing a fixed amount of money at regular intervals, regardless of market conditions, you reduce the risk of making poor decisions based on short-term market volatility. This approach allows you to accumulate assets over time, taking advantage of lower prices during market downturns and buying fewer shares when prices are high. Dollar cost averaging is particularly beneficial for investors who want to grow their portfolio consistently without the stress of timing the market. Building wealth takes time, discipline, and a solid plan. Focus on setting clear goals, diversifying investments, and sticking with long-term strategies. If you found this video helpful, be sure to like it and subscribe for more content like this. Consistency is key. There's no shortcut to instant wealth. Take control today and start building the financial future you desire.